Hey, welcome back to the Victor H Investing live stream. I'm Victor H, and in this live stream, we're going to go over the biggest earnings that we saw today. It was another huge day where we saw some big companies announce after the market closed, and I'd like to go over that information with you. The companies include Apple, it includes Amazon, and a couple of others like Intel, Booking, Mercado Libre, and Shell. And of course, any company you want to talk about, because I'll take any requests that are out there. I'd be happy to go over it. Just to kind of get things rolling, it's what has been a really wild week of trading. We have a market that can't make up its mind. Is it going to go down? Is it going to go up? Is it going to go down? It's been a real roller coaster. If you look at the NASDAQ, if we look at the NASDAQ over the last 6 months or so, see if we can get the right chart there. It's approaching correction territory, which is defined as a 10% drop. We're at about 8%, and another down day like today, and we're in a correction for the NASDAQ. The S&P is faring far better. I think it's doing, it's only down about 4%, but it's down. So what's been wild is this whole volatility. If we look at the last 5 days, again, the S&P, went down, it went up, it came down. Certain stocks just seen really, really extreme volatility. To me, volatility is fear. There's a lot of pressure for some investors to get out, and they get out quickly. They use a term that stocks usually go up on the escalator. They kind of go up over time and go up in price, and they go down in the elevator. So when things begin to drop, they drop fast. We'll see if that's the case. The other kind of thing that I noticed, if we look at the 1-year chart, roughly 1 year ago, August 1st, began the correction to the S&P. That's when it started correcting in 2023. So I know that I've seen some commentators say, if the first half of the year is positive, it's very few occasions when the second half doesn't continue. And I could agree with that, hey, the market's been doing well. I think companies are strong. They should continue to advance. But it doesn't preclude them from having a correction like the one we're seeing. Corrections are good where we can pull back some of these prices so we can get some reasonable valuations and not let some of these stocks that are overheated just, break away and stay away just with no tie to fundamentals. So keep that in mind that, hey, we may have a correction, but I still think the stock market's a good investment over time. And heck, for the second half, we have a bad month, maybe 2 bad months, I bet you we'll have a really nice finish to 2024. It looks like I've got my first comment. David, thank you so much for joining, sir. I appreciate it. So the market is sold off today, and in some early action, we're seeing that Apple reported and they're down a little bit in after hours. Amazon reported they're down 5% in after hours. And Intel is down 18% after going down 5% during the trading day. Holy smokes. Combined, that'll be more than 20%. That's going to hurt. And then we've got Booking down almost 5%. The Mercado Libre is standing tall, up 11.5%. I'm going to look at all these in detail, but let's just kind of do a flyby. Okay. So we know that Apple is, I believe, the biggest, most valuable company on the stock market. They were $3.35 trillion in valuation. They shouldn't drop too much, but we'll see. When it opens tomorrow, it may be pretty bloody. We'll see. Now, I've got the investor homepage loaded up, and I'd like to go through their earnings. So first, Apple, in their release, they didn't write much. They just said, hey, our revenue is up 5%, which, okay, it's up 5%, but it's really important. What makes Apple really valuable? Well, let's take a look at my desirability chart. And I put Apple in the green for my desirability chart, but not completely in the green. And here's why. Is Apple, for their iPhone, they have competition. They have competition from Samsung, from Huawei, from other companies that are pretty strong companies. So it's not like, hey, Apple just does their thing and they have no competition. So they act like a monopoly. No, that's not the case. In fact, I'm going to show you in their financials that iPhone sales are going down. Well, that's a big problem because if you're not the biggest and the number one player, that could be a problem for the company. So I put Apple in this space here. Most of it is very desirable as a company. They have a great network. They're, the Apple community of apps and how they charge for those services, very lucrative. But that could go away. That could go away to other vendors like Samsung and Huawei and others that make smart devices. So that's where I put Apple. Now let's come back to their earnings. So they did grow their revenue, but let's take a closer look. And I'm going to dissect their income statement. They did break out iPhones. And you can see that for the quarter, sales were slightly lower. They were lower by about 400 million. And my biggest complaint about Apple for some time has been they're not growing. You're paying more than $3 trillion for a company that's not growing, and this is proof to it. And in fact, it's worse. They're losing a little bit of share. And if you look at the first 9 months, the problem's even worse. You got a couple, call it $1.7 billion of loss of sales if you compare the first 9 months of 24 to the first 9 months of 23. That there is my biggest worry behind Apple. If they start losing share for iPhone and they become this, some people use iPhone because it's a cool brand and so forth, but the masses use another device, game over. This stock will lose so much value because they're not going to be the number one player, the big monster, the monopoly. That's going away. I also think that Apple, I'm not a believer in their AI strategy. If you look at how they've been a laggard in certain markets, it hasn't really paid off for them. If you look at like the whole the goggles they came out with, Meta had come out with their Oculus set, way ahead of them. And then Apple came out with a super expensive, set of goggles for virtual reality. Now, I think they're really impressive, I guess, if you wear them, but they were like 5 years late, if not more. It's like, what are you doing releasing a product like that? Then they had the Apple Car completely scrapped. Now they're saying, oh, we're going to have Apple Intelligence. Well, they're flat-footed on that. The companies that are really, really going to make AI happen are companies like Google, ChatGPT, Microsoft's doing okay. Meta has got an awesome AI strategy, and I can go on and on, but Apple hasn't really been focused on that. So now they're looking to partner. Hey, you can use our network, all these users of our devices, but their user base is dwindling a little bit. How can they start growing? How has Samsung become the leader in this space, in a space that makes this company worth $3 trillion? So I think the earnings were okay. I think I'm underwhelmed with their earnings, but I've been underwhelmed with Apple for some time. Now let's take a look at their valuation and see what I think the company is worth. And then we'll see what the stock price is trading at and see if Apple is a good buy, a hold, or a sell. And then we'll go from there. So here's Apple. Apple's a obviously respected company. Warren Buffett owns them, which is, I'm sure, a very big reason why so many people own Apple. If Warren Buffett, if it's good enough for Warren, it's good enough for me. But Warren Buffett has been selling shares, by the way. I think everybody knows that. So, okay, so we got our valuation spreadsheet for Apple, but I got to update their data. So let's make enough room on this display so we can have both screens on so you guys can see what I'm doing. And we'll go to Apple, make this guy a little smaller, and then we'll be ready for business. Everybody, thanks for tuning in. I know some of you are outside the US and it's pretty late where you're at, so I appreciate you staying up late. I'll try to make it a little entertaining in case you're missing your favorite show on Thursday night. So here we go. Apple, they are a $218 stock. Let's call it 213 since they are trading up 215. So the value stock share 215. We'll pop that in there. Their market cap, when I last did this company, they were 2.8, but it looks like they've risen to 3.3 or so because they're going to take a small haircut tomorrow. Not too bad. All right. So Apple is a cash flow generating machine. They generate tremendous cash flow. It's pretty impressive how much cash they generate. Let's take a look at their financials and see what's going on with cash. Where is my favorite statement in the financials, which is a statement of cash flows. It has all the gravy of a company. And here's the statement of cash flows. It looks like cash flow for the first 9 months is trending up on the operating line. So they were roughly $89 billion of free cash generated. Now they're at 91.4. And we have to deduct plant, property, and equipment, which is CapEx. So we deduct these lines. So if I'm going to annualize that number, and I'm going to take 91,443,000,000, and I'm going to subtract 6,539,000,000. And of course, to annualize it, I'm going to need to divide by 3/4. And I didn't add something there. So divide by 3/4 and then multiply times 4/4 to give me an annual rate. The annual rate is 113 billion. And think about that. Some businesses are not even a quarter of that size in top line revenue. And these guys generate that much cash per year. That's why they're worth 3 trillion. And they're going to continue to be worth that unless that gets threatened. If the revenue begins to decline at a substantial level, it will become a lower valued company. But let's keep investigating. I'm going to go with the low discount rate because they're a superb quality credit company. These guys have tremendous cash on the balance sheet. In fact, let's take a look at their cash balance. Their cash on the balance sheet and their cash is all over the place. They have cash here, marketable securities, and then marketable securities down here. So they have so much cash. It's ridiculous. So we got to add some big numbers and get to that cash number. So $153 billion of cash and marketable securities. Debt, they have $86 billion of debt. And they have some term debt up here. So we're going to add those two figures. All right. So we're going to go with plus 86,196,000,000. And then we're going to have the term debt was 12,114,000,000. All right. So we've updated our cash forecast. I'm going to leave the growth rates the same. It gives me an intrinsic value of $3 trillion. Add the cash. Take away debt, gets to an equity value of $3,091,000,000,000. The market cap's above that by about 6%. Now, paying a premium on Apple of 6% might be reasonable if I believed in the company. But as mentioned, I believe there's pretty good risk in the company. Let's take a look at the earnings per share for Apple and value it based on earnings per share. So analysts think it's a buy, price target 235, and it's discounted by about 8%, soon to be about 10%. The earnings per share for this year, $6.72. I was pretty close. I'm going to leave their PE at 25 and say they're going to grow at 8%. That might be optimistic. So let's go with 6% because you just showed that they grew their revenue by 5%, and they have a hard time growing. So you're looking at the stock. We're looking at a company that is being priced at a 10% premium. And again, if I believed in a business and I just want to be a part of their future, maybe I buy a company at a premium. But I'm going to come back to this chart here. I think that Apple is a one-trick pony right now, which is that iPhone. And if you're a one-trick pony and you're dominant, that's one thing, but they're not dominant. If you look at smartphone sales, they're in second place to Samsung. Well, that's a problem. Then you have Huawei over in China that sells a very capable smartphone to the rest of the world outside the US, because you can't buy a Huawei in the US. And that phone is sold at, I don't know, a third or a fourth of the price of an iPhone. Well, people, now that we have a little bit of a slowdown in the economy, they're going to be looking at $1,000 iPhone and going, wait, I get a device for $200, maybe $300. That's 90% as good as an iPhone. And it has all the same features and so forth as an iPhone. I think I'll buy that device and save the $700 or so compared to an Apple. I think that's going to be the case. And frankly, I was a Samsung user before I started using iPhone. I use iPhone because my beautiful wife likes iPhone. My family, we all use iPhones. But I was very happy with my Samsung device. I thought they were, from a device manufacturing perspective, it's an excellent company. So I'm thinking I'm either going to go back to a Samsung on my next refresh, or I'm going to go back to a Google Pixel. And we'll see which one wins that battle. But I'd like to go back just simply because first, I'm a Google stockholder. But second, I just think that Apple is on their way out. It's going to take a while because they just have so much damn cash. And that's my opinion on Apple. The stock is trading down a little bit. Last time we looked at it, let's take a look again and see where the stock is trading. Now we're seeing after hour trading, right? And it's down 2%. But as we saw today, the sell-off was pretty intense. So intense, it's driving Google to crash. Look at that. Come on, Google. You can handle this. Crazy. Come on. What is going on with Google? All right, here we go. Google can't handle a bad market, I guess. So if you look at today's trading, one day, market opened up. It went up because here's the dotted line where it closed the previous day. So it was up, call it, 0.7%. And then it said, all right, we're going down, people. And it came down to the low point. It was down 4% from the high point in one day. When you see that extreme volatility, there's a lot of sellers that are taking action. This usually means that big hedge funds are like, hey, I'm selling a big position on a stock. I'm selling out of something. So where I'm leading is these stocks, if we open up, at a particular level and we have another day like this, wouldn't be surprised if Apple's down 5 to 10% tomorrow. Wouldn't be surprised, because that was the case today. You saw some quality companies just get hammered. So we'll see. We'll see what happens. So that's my review of Apple. Any comments on Apple? Let me catch up on comments. And hey, Bad Omen, good to see you, man. It is going great. This market's really down and it's, really red. But for the last month, maybe two, I've been saying, man, the market looks expensive. I'm going to sell out of some positions and create some cash, because cash right now is really a good tool. It's a good tool to buy discounted stocks. So this is, one of the areas of investing that should be fun if you get prepared with the right emotional state of mind, which is when the stock market starts discounting stocks, let's not buy into the fear, which is, oh no, this stock just dropped 8%, 10%. Instead, let's go do our homework and say, hey, great, a company I want to be an owner in just dropped a significant amount. I'm going to buy more shares. I bought a lot of shares today across the board. I bought stocks like Google, bought stocks like Airbnb, because I want to be an owner in those businesses. And when the market says, hey, I'm going to give you a discount today, I say, thank you very much, market. I'll take it. So good to see you, Shadow Guy, throwing the Spanish around. Very nice to see you, sir. Take a look at Toyota. Glad to look at Toyota and provide some comments on Toyota as well as the car market. Quick comment is I'm really careful with car companies right now. I own Ford and it has not been fun. It's been brutal. It's like, holy smokes, they make money, they generate cash, they grow their revenue, their lineup looks good, but the market doesn't like car companies. So I'll get to Toyota. We'll take a look at it, but I'm going to give you a preview of probably what I'm going to say in that section. And then Dylan, thanks for joining. No way, 2 days in a row. This weekend, we could do live around 4 p.m. or 6 p.m. And what are you talking about? Pacific Standard Time, Eastern Standard Time? Give me a little more information there, and I can see if I can accommodate. We're going to do a live stream with Scott's Due Diligence on Sunday at 12 p.m. Pacific, 3 p.m. Eastern. If you can make that, that'd be awesome. Let's make it an awesome live stream because, Scott's Due Diligence, I'm not shy about my respect for the guy, my appreciation for the guy. And I think we bring two different perspectives on stocks, and I think you guys would probably enjoy it. So, Dylan, this weekend, it's hard for me to do 4 p.m. or 6 p.m. Eastern. And the reason for it is on Saturday, I'm going to do a morning session with probably the conference call. We can jump in and talk about investments in the morning on Saturday. And then on Sunday, it's going to be at noon. The afternoons, I leave it open for my family. We go out and do fun stuff, principally with my wife. So it's probably not going to happen on the weekend. But during the weekday right now, it's about coming up on 6 p.m. Eastern. So, hey, here we are, man. So hopefully you can ask your questions and let's get into some stocks. It looks like Best Of is checking in. Thanks, man, for joining. I appreciate it. All right, we're done talking about Apple. Let's talk about Amazon. Amazon is down 5%. Amazon's an excellent company, and they are just, in a lot of ways, so damn amazing. I put them very high in the green of my desirability quadrant. I like companies in the green that are very high. Why do I think Amazon's like a monopoly? Well, their e-commerce business is massive, and they're becoming such a force in retail or e-commerce, and they are really even changing the way that the economy works, the way people are buying, the quickness in how they deliver, just the fact of making it so convenient to buy is so impressive through their e-commerce business. It doesn't make a lot of money, but it just controls so much for them. Their AWS business, they started that particular category within the industry. And now it's the biggest profit generator for the company. And that is clearly a differentiator. It's number one in the category. So they're number one in e-commerce retail, number one as a hyperscaler. And I can go on. And they've started other businesses. Now, the one concern I think about Amazon is they're getting in too many businesses. Are some of these businesses going to begin to really fail? And that could be a liability for them. But for now, I think it's an incredibly desirable company. I've owned Amazon in the past. I got out of Amazon late 2023, and I haven't been in Amazon since then. Let's take a look at their earnings and then look at their financials. So I have not looked at their earnings at all. So we're going to be doing this on the fly, and this is just going to be unplugged analysis on Amazon. So let's look at the earnings release. So I'm going to make this a little bigger. Hopefully the font is legible for you guys. So net sales increased 10% to $148 billion in the second quarter. They were at $134 billion. Okay. So North America grew 9%, international 7%. AWS grew 19%. Okay, awesome. Great job. And operating income increased 14.7 billion. That's good. And we'll look at the financials. So net income increased to 13.5. We'll take a look at the percentage there. Free cash flow increased to 53 billion in the trailing 12 months. So let's remember that number. I'm going to write it down. 53 billion in free cash flow in the trailing 12 months, because I'm going to use that number. All right. They use some cash flow to pay back some finance leases and obligations. All right, perfect. So as I go to Amazon, I tend to look at a financial set of financials in a press release with my concerns about the company in mind and the really important parts of the company in mind to make sure they're really growing those parts of the business and really operating quite well. And if there is any sign of weakness, I kind of dig a little deeper. All this stuff is interesting to read, but right now I need to work a little quick so that I don't bore you guys to death. So third quarter guidance, they're going to be at 154 to 158. That's sales of 11 up to 11%. I think that guidance disappointed the market a little bit. They're saying, wait, you guys are kind of slowing down your growth percentage. You're growing, your sales growth is slowing down. You're still growing, but not at the same rate as you did before. So that is a concern. So we're going to start with cash flow. Look at them. They're just showing off their cash flow report. Now, one thing, we're at 24, 12 months ended. It's very nice to see that their their cash from operations has gone from 62 billion to 108 billion. Phenomenal. One thing Amazon's had to do over the years is put a lot of capital back into their business because they have these big warehouses. They're hyperscalers, so they have to buy hardware for these data centers, GPUs, all kinds of expensive stuff. Now, that is somewhat of a setback, but that's fine because they put a lot of cash from operations on the statement. So overall, a very good number at $53 billion of free cash flow if we look at the trailing 12 months. If we look at net sales, net sales are not looking great because you look at, I think their product sales are what is being sold at e-commerce. And for the quarter, they went up slightly. It looks like it went up about 2.5 billion out of, let's say, 60 billion. So that's really about a 3% growth rate. Services is probably going to include the AWS hyperscaler. It grew nicely by about 11 billion. So that's better growth. That's a lot better growth. That's in the double figure territory. So when we look at the first 6 months, you have decent growth. They continue to grow. And this is what we just covered Apple. This is what Apple doesn't have. Amazon's also a massive company, but they're growing. Big difference. Apple is a massive company, not growing. And it's showing that, hey, they can't sell what they used to sell before. They're actually beginning to decline. So I think Apple has problems. So, all right, so Amazon has modest growth, which is good. And we looked at their statement of cash flows. That's fine. So AWS, this is the big, profit generator for the company. It went from, for the quarter, it went from 22 billion to 26 billion. So that's going to be roughly about 15%, 16% growth. Very good. Operating expenses did not increase that much compared to the increase in revenue. Very nicely done. That means they're charging more, or they're cutting their cost, or they're managing their costs really well. That's impressive. Now, for the first 6 months, it went from 43.4 to 51.3. Nice growth. And again, their costs are really being controlled well, to the point where their operating income on the AWS business is very impressive at an $18.7 billion. Nicely done. Nicely done. You look at a business that's much larger, like their, so this is AWS. And I think this is their whole business, but I'm trying to get to their e-commerce sales. I'm not sure where to see. Oh, here we go. So this is e-commerce. E-commerce has a much larger sale number, but their profit isn't very high. But the good news is they're increasing that profit. So that's actually a really good sign. So I'm liking what I'm seeing out of their business. It's getting stronger, more profitable. Very nice. Sales growth, 11% in North America, international 8%, AWS grew by 18%, consolidated, they grew 11% overall. Again, very impressive that it's such a big company and it continues to grow. Awesome. Cash, they have plenty of cash. They've got 71 billion in cash, 18 billion in marketable securities, and then long-term debt of 78 billion. So we'll put that into my valuation model and see what we end up with. So let's go ahead and kick over to the valuation model and see what we think, or what I think Amazon's worth, and then compare it to the current stock price. So let's take a look at Amazon. So Amazon, excellent company. Got a ton of respect for the company. Things they've done, they just blow me away. So trailing 12 months, they told us was 53 billion. So they made that one easy for me. So we'll change that from 2023 to trailing 12 months. Make that there. I'm going to keep my growth rates the same, and I'll show them to you in a little bit. We're going to discount at 8%, and based on the intrinsic value of those cash flows are going to be $1.6 trillion. All right, so let's take a look at, I want to look at assets now, and I want to look at the cash balance. We're going to add $71 billion, 178 million, plus $17,914,000,000. And then their debt is going up a bit. Their debt's fine. Their debt's lower. I was looking at these leases. So their debt's come down a bit, which is very good. Very good to see them pay off their debt. So 54,889. Any debt in the current liabilities? Nope. Looks good. All right. So the company, based on cash flows, their cash flows plus cash minus debt are worth $1,676,000,000,000. But the market cap of Amazon is currently $1,920,000,000,000. So there is a separation between the stock value and the stock price, which is, I'm going to say, $174 a share with the haircut they're going to take. So based on free cash flows, Amazon's being sold at a premium of 7%. And if we look at their chart, they've been coming down a bit, but it's really been an impressive company. And look at that. You could have bought Amazon $84 a share and doubled your money. Beautiful. Tracking these awesome companies and buying them at great prices. It doesn't get any funner than that. And now the stock is a little expensive. It's about 7% too expensive based on free cash flows. But let's take a look at their earnings per share. Earnings per share for Amazon is expected to be $4.66, and they're going to grow very fast. Look at that growth rate. Go Amazon. Holy smokes. Well, I'm doing my part. I can tell you my household buys a lot of stuff on Amazon. And we're happy because they deliver. It's incredible that we can order something and sometimes it gets to our house on the same day. It's like, how is that possible? They're going to grow really fast. I'm going to go with 20% growth. Actually, that's a little too ambitious. 15. I put a high PE. I'm going to lower that a little bit to like 36. And Amazon's being priced at a premium of 12%. Okay. Now, if I really want Amazon in my portfolio, maybe I pay that rate, or maybe I just wait for this market to just keep, banging away at stocks with these, decrements of share price. We see that the NASDAQ has just kind of been tearing up companies. The last day was down quite a bit. We look at, I think I saw the overall drop in the last 30 days, call it from the peak to the bottom, is 8%. Well, if you let the market continue to correct and maybe it takes Amazon down another 10, 20%, and then I'm a buyer because I'll buy Amazon at any type of discount because the company is just so freaking good. But I just don't want to overpay. There's really good quality companies like Meta, Google, Airbnb, Uber. There's other companies that I can put my money to work. But Amazon definitely is on my watch list, and I'm going to be watching closely to see if it drops enough where I could be a buyer of Amazon stock. So my opinion on Amazon is that it's a great company. It's being sold at a premium, but that stock price continues to come down. If it gets south of that 160 number, I think I'm going to have to buy. I'm going to have to buy. Actually, I need it to come down to about 150, and then I'd be willing to buy. So I'm going to be tracking this guy, putting it on my watch list. It's already on my watch list, and I'm going to update my data. All right, so we got through the two biggest companies that announced today. Combined, they're over $5 trillion in value. Man, we're just picking off the companies that reported today. Now, the big problem child is Intel. Let's talk about Intel, shall we? And see what the heck happened that caused a 20% drop. And, Intel is just making it a habit of, a year ago, they had big failures that caused a big stock price. And 2 years ago, same story. So come on, Intel, get your act together. Just clean up your business and start being consistent. We look at, and I don't know what's going on with Google today. Maybe their servers are a little overloaded. You look at the 5-year, it's like, Intel was right there with the best of them. It was trading at $60 a share, $65 a share. And then they went on this collapse. They sold off by 60%. And, a lot of companies did. So, okay, we'll give them a pass. And then they rose nicely, but then they crashed and burned. They went up 95% at that point, and they more recently have crashed and burned by 42%. Well, is it a buying opportunity? Well, let's take a look at what the heck's going on, because I don't want to buy a company that's screwed up. Now, I think Intel is a desirable company. At one point, they were squarely in the green, but it's been a while, and I'm going to get rid of some of these logos so it could be a little cleaner. A long time ago, Intel was here like 20 years ago because they were like the leader in semiconductors. If you bought a PC, 90% of the time it had an Intel chipset. So they were just printing money. They really controlled a big part of the market. But over time, their competitors kept getting stronger. And now Intel is somewhat selling to the less desirable parts of the marketplace for semiconductors, and companies like NVIDIA, Broadcom have really, taken over. And even I think Qualcomm's more valuable than Intel. AMD's more valuable than Intel. So Intel used to be number one, and now they're like number 5, number 8. Who knows how far down they've fallen, but they have fallen. So I put them in the gray, meaning that, it's a business that can be profitable. And if you buy them at a good price, it could probably give you a good return. But boy, it comes with problems, to say the least. And let's get into the problems they're having and see if we can figure out what the heck's going on with Intel. Why are they so screwed up and their stock price is dropping 20%? That's just nuts. So here's your Q2. Let's take a look at the earnings release. Now, when they got their new CEO, I have to admit, I thought he was the real deal and he was going to kind of fix Intel. But I don't know, man. I'm beginning to lose faith. He's had plenty of time to kind of get some things rolling, and it's not good. So, summary. So this is the earnings, and make sure I'm reading the right date. June 29th. That's fine. Wait, June 29th. Okay, that is correct. All right, let's keep rolling. And second quarter revenue down 1% year over year. Okay, well, that's not like, I'm not having a heart attack over that. That's fine. And then we have third quarter is forecasted to be 12 to 13 billion. So you'll have sequential growth of some sort, or they'll be flat sequentially. They're going through a cost reduction uh, uh, process and eliminating 15% of headcount. And I think that's why the market's freaking out. It's like, oh my God, they're letting off people because they see bad things coming for their business. And that might be the truth. All right. So, and they were disappointed. Okay. So when the CEO is telling you they had disappointing earnings, it's disappointing. So Intel pretty much did not perform. I was optimistic because I've seen that PC sales are getting better for companies like Hewlett Packard, and Dell even reported that PC sales are good. So I'm surprised that these guys laid an egg, that they're down 1%, that they're saying, hey, we need to lay off people. And the news is bad with Intel. So the news is bad. The business, I might say, is a little broken, but let's take a look at this. So Intel Products Client Computing Group. So this is, I guess client would be like PCs, if I'm reading it correctly. And I guess the information I'd been seeing is correct. It's up 9%. But if you look at the data center where all the action is for semiconductor companies, that's why NVIDIA's worth so damn much. It's down 3%. You're going in the wrong direction, Intel. You're supposed to be going up right now. Network down 1%. But this, I think, is the killer. Everybody else is growing data center, but Intel does not have a good growth in the data center. The small businesses, they're down 53, down 3. These are smaller businesses, not as strategic, but it's still disappointing that they're down. All right, Intel, man, you're giving me a headache, Intel, because I do own their shares. Not a lot of them, but it's still a headache. All right, so sales, we just went over. They went down by 1%. Did they lose money? Let's see. They did lose money. So they lost $1.6 billion. Their operating expenses went up like $900 million. Why did they go up so much? So if your revenue's down, why are your expenses so much higher? That's kind of nuts. I think restructuring, okay. I guess they're offering some severance packages to people to give them an exit plan and say, hey, if you take this exit package, we'll give you some money. Okay, so that's $743 million. So that's a big part of it. So they're kind of expensing what they're going to have to pay people and about for this 15% reduction in force. All right, so that kind of makes sense. It's still disappointing. All right, so coming down, assets, looks like they have more cash. Good. Okay, that's good. Statement of cash flows. All right, so cash from operating activities. Man, just $1 billion. Oh, man, guys, this company used to be a cash flow machine. Let's go back in time. Let's get in the time machine and go back in time with Intel and show you that back in the day, this company, when they ruled Earth, they would generate 10 billion, 14 billion, 17 billion, 21 billion, 9 billion. And now, for a while, they've been like, all right, something happened that screwed us up, or maybe the market just became so much better than us. We're losing cash flow. And when we look at an income statement like this, looking historically, it's like, guys, when are you going to come back? Will you ever come back to that business you used to be? I don't know. I'm beginning to doubt them. They're at $1 billion in cash from operations for a whole 6 months. And now they have to put money into the business. So they're negative free cash for 6 months of over $10 billion. How long can you survive if you're going to be burning cash like that, losing market share? You got about maybe 2 years, maybe 3 years of time to get this business back in order, Intel, or you're just going to be gone. You're probably going to have to sell yourself to another semiconductor company. And it's hard to fathom that this company 20 years ago, this was one of the huge companies on the stock exchange. They were one of the biggest and the best, and now they're one of the weakest in their own industry. So I've seen enough. I'm not buying any more Intel. Their business, let's go back to my desirability quadrant. I was playing around with kind of putting them down here, and I am going to move them. I'm going to be like, guys, you're so screwed up. I just don't want to touch you. You're too radioactive. I'm moving you down here. I think they got to get their business squared away. I'm going to need to figure out how to get out of my position in Intel. But I just need them to, figure it out and then see if they can come back with a stronger business. But I just don't want to be in the Intel business anymore. So interesting, but disappointing. Too bad that Intel is going down for the count. It is historically a very important company in the United States of America because they helped build the PC industry. My first PC had Intel chips in it, but investing is not an emotional game. It's a thinking game with hard emotions. So we move on. Dylan, Orc Night. So it's a bit hard to make that work. Yeah, I'll kind of fluctuate on start times, man. Hopefully you can join. I really appreciate you being on this one. Alexander, greetings from Chile. Hey, man, good to see you. I think you've been on a live stream before, and I said that Chile is on my bucket list. I got like 100 places on my bucket list, but most definitely I'd love to be able to go from the beach up to a high mountain in the course of a day. That would be super cool. So I'd love to go see your country someday. And I just got done talking about Intel and concluded that, man, it's just disappointing in a lot of ways. More importantly, structurally, I just don't think their business is ready to compete. They've had enough time. They've had a new CEO. Something's broken at Intel. Why the heck can't they get their business in order? And maybe in a year or two, it might be investable. But for now, I need to figure out how to get out of my Intel position. Have I ever gone to a shareholders meeting? I've attended online and participated that way. I've never physically gone. And I think part of it is the expense, right? You got to get yourself to a shareholder meeting. I did go to one, which was with what is now Chevron, because at that time, the company that I worked for was headquartered in Los Angeles. I live near Los Angeles. That company got acquired by Chevron. So I've been to that one. But other than that, I don't really go to shareholders meetings. I don't know that you get a lot of useful information at a shareholders meeting. It's administrative, like, hey, we're voting in an officer. Hey, we're, kind of figuring out, to use simple terms, is what kind of coffee we're going to order for the break rooms and stuff like that. So, and not as simple as that. Of course, I'm joking, but it's not like, hey, this is how we're going to change the business to be more competitive and competing against our competitors. It's none of that. It's really administrative. So I don't know that it's a good use of my time. I'd rather listen to the earnings call and listen to management explain what happened in the quarter. Mike, the dividend investor guy. It's good for you to join, sir. You can always see the recording, and it looks like you have another comment. Have you looked at HUM and SHOP? I haven't looked at them. Let's see if we have some time to look at those, and we can definitely look. Okay, so thanks for joining, sir. All right, so we're on to bookings. Now, I wanted to look at bookings because I'm a big Airbnb stockholder, and I believe Airbnb is squarely in the green that you've seen. Now, when I look at bookings, if you remember Priceline.com, they used to be, a travel website where you would go in, you'd, get a pretty good price on an airline ticket, hotel rooms, and all that good stuff. Well, they realized that, hey, Booking, which is a European operation, is really killing it when it comes to booking in a different way. A lot of short-term rentals are on bookings, and they kind of were trying to imitate or resemble Airbnb. So Priceline acquired Booking, renamed themselves Booking.com. And for the most part, they do short-term rentals like Airbnb, but they also operate, other travel services like booking hotels and stuff like that. Now, my background, I bought 2 properties in 2012 that operated as short-term vacation rentals, and I put them on Airbnb. I put them on booking.com. I put them on 2 other big websites. I forgot the names of them, but I sold those 2 properties in 2022 and did really well with the real estate investment overall. And I made lots of money on Airbnb. Airbnb would be 80 to 90% of the traffic. And as I studied that industry, because I had 2 investment properties and that it was important for me to stay current, Airbnb just took the mind share of the market. They were not the first ones to the category, but the user experience just blew everybody away, and it still does. I think booking the user experience is good, but not as just overall appealing as Airbnb. And to the property owner, more importantly, booking.com operates like a hotel rental company versus Airbnb truly is a shared economy experience for the owner of a property. I don't think that a lot of people see that part of it because they see the customer side of it, the traveler side. But when you look at the property owner side of it, there's a big difference between booking.com and Airbnb. Having said that, I put booking.com mostly in the gray and partially in the green. That they do have a competitive advantage in Europe. I think they're really popular in Europe. When I travel in Europe, I ask about Airbnb. Hey, do you use Airbnb a lot versus a booking? And I think they're pretty competitive in Europe. In the United States, it's not competitive. The Airbnb stranglehold on travel in the US, and they're doing really well in Asia. They're doing really well in Latin America. They just do really well. So having said that, that's how I feel about the company. It's a desirable company, but not as desirable as Airbnb. They're down 5.5% in after hours trading. Now let's see why. Why are they down that much? And their symbol is BKNG. Investor relations, booking. Let's take a look at what this company had to say and why their earnings are down a bit. All right, so Booking Holdings, we know what they do. They help with travel. Nights booked increased 7%, so volume increased. Okay, that's good. Revenues increased by 7%. All right, we'll take a look at their financials. Now, did they guide third quarter dividend? Now they pay a dividend. Airbnb doesn't, but Airbnb is growing tremendous amount. And the appreciation on the Airbnb stock is beautiful. I'll take appreciation over dividends any day. Cash looks good. They got a nice cash position. They actually grew their cash. Very good. And how much debt do they have? Short-term debt's $3.4 billion. Long-term debt, 13. So they have close to the same amount of cash as they do debt. All right, sounds good. Good balance sheet. If you have about as much cash as debt, it's looking good. So you see how, like, if you look at Airbnb, there's a difference. Merchant revenues, agency revenues, advertising. All right, cool. Total revenue, $5.8 billion in the quarter versus 5.4. So that's a $400 million clip. And I'm going to guesstimate that's about 6% growth, maybe 7%. All right. And for the first 6 months, it looks like they grew about $1 billion. So that's going to be about a 10% growth rate. Very nice. Very nice. All right. So they grew nicely. Now, they're not a giant company. They should be growing a little faster. I think Airbnb is much larger than that, and they grow at a higher percentage rate. So it'd be nice to see them grow faster. Again, we saw Amazon growing at 11%, and they're like 200 some odd $billion in revenue. These guys are, 10 billion for the first 6 months, and they're growing at just slightly 2-digit growth rate at 10%. So looks good, but not impressive. All right, cash flows. Cash flow grew nicely to $5.2 billion. And we look at property and equipment, not very high. So they're about a $5 billion company for the first 6 months. I'm going to double that to get to $10 billion. It's a growing company, so I'm going to multiply times 20. So 10 times 20. These guys can carry a valuation of up towards $200 billion, and they are a $124 billion company. So this might be a discounted stock. If they keep growing, they could be a nicely discounted stock. Recently, they've seen a nice drop. Wow, what the heck happened? So last month, they're down 5%, but year to date, and I like using Google because they give me the ability to show a drop in revenue when we see, a drop in stock price when we go from here to here. So they dropped 11% recently. So that's provided a nice entry point. So Booking, I mean, if you're looking for a travel company that's growing modestly, but it's growing, it looks pretty impressive. Um, their their revenue that came in looked good. Their cash flow looks good. So I would say this one's interesting. I'm an Airbnb stockholder. I haven't seen enough to switch horses. It wouldn't be the right investment for me, but I could see that a lot of people would be interested in it. In fact, Booking comes up on request when I do live streams. It comes up quite often. I think some people are interested in it. I can see why. They got pretty good fundamentals. This is a good company. I think they reinvented their business back in the day, going from a Priceline business over to a booking business, which makes them more modern. So I think it's a good business, and they had a very good earnings. Why are they down 5%? So stock price is going to be even more attractive. So that's interesting. I don't see why they'd be down 5%. Maybe on their guidance, if you study that, maybe they guided and said, hey, the next couple of quarters aren't going to be as good. I would encourage you to do that if you're interested in that company. Mercado Libre. So Mercado Libre is a e-commerce company for Latin America, for Spanish-speaking Americas in South America. And they do quite well. Let's take a look at their earnings because I'm curious about this. I have it on my watch list. I've been kind of in a hold pattern on buying too many new stocks, and maybe it's going to cost me some money on this occasion because I have them on my watch list. It is kind of a buy, but I've said that the market's expensive and I expect it to sell off. And this stock had been selling off, but today it is up big. So let's take a look at their results. So view results. All right, guys, where is your results? So they did a letter to shareholders August 1st. Okay, we're on the right track here. So net revenues went up 42%. Impressive. Very nicely done. Income from operations, 726, 14% margin from an e-commerce business. That looks really good. Payment volume up 36%. Volumes up 20%. So somehow they're getting a better price, if I'm reading this correct. Somehow they're getting better pricing, and because their volumes are up 20%, but overall net revenues are up even higher. So that's good. All right. So they are doing well, growing well. They do predominantly e-commerce business, but I'm sure they do other services as well. Let's take a look at, I'm trying to get to some financial statements and try to analyze that real quick. Okay. So we got 3 months ended June 30th. When we compare the two, so fintech monthly users, looks like they're trying to get into fintech. They had pretty good growth there. Volumes went up, as mentioned, about 20%. And payment volumes were up substantially. Okay. Here's the countries where they operate, Brazil being the biggest, Argentina, Mexico. All right. Those are, and by the way, the Mexican economy is doing quite well. I'm not sure about Argentina. I'm not sure, and I'm not sure about Brazil, if they're in a good economy or a bad economy. All right. Hopefully they give me a financial statement because I just like getting my head around financials. All right. So here we go. Balance sheet. So balance sheet, they've got about $3-4 billion of cash. And are we in US dollars? Yes, we are. All right. Looks good. So short-term investments. So they're actually about $7 billion in cash in short-term investments. All right. They have long-term investments, and I'm not sure what that is. If it's marketable or if it's not marketable, can they turn it into cash quickly or not? So I'm not going to include it. So they have about $7 billion in cash, and so loans payable is here. So 2.4. And then loans payable here. Okay, so they have about 4.6, 4.7 in debt, but they have about 7 billion in cash. So more cash than they do debt. See if they give us a cash flow statement. Here it is. So cash for the first 6 months, 3.4 billion. We look at the capital they have to put back in the business, which is down here. So let's call it that they're at 3 billion in cash, free cash. This is a really growing business. So I'd actually be willing to multiply it times 25. So we go 3, double that to 6, multiply it times 25. We get up to about $180 billion of potential value in this company. And they're at a market cap of 80 billion. So this one, I already have a valuation going. I'm going to update that and see where I arrive. I might be paying a higher price for this stock, but I think it might be worth it. I got out of Amazon and made money. Awesome. Nothing wrong with that. But I'm like, I'd like to own an e-commerce leader. And these guys are the leader in Latin America, growing really well, making money, generating free cash. So we said that when we look at their cash, and I'm going to need to make this smaller, or we'll just have to read these numbers. All right. So I'm going to annualize that number. I'm going to go plus 3394 minus 329. So this is free cash flow for 6 months, but we know we want to double that to 12 months. So multiply that times 2. It's $6 billion. Now, they're growing that number dynamically. That means fast. So they grew their operating cash flow by $1 billion. On this number, that's about a 40% growth rate. That's phenomenal. Great job. But their CapEx isn't like exploding. Like our friends at Amazon, they have a lot of CapEx, but these guys don't have a ton of CapEx. Good job, Mercado Libre. Somehow they've figured out a business model that is going to be good. So I'm growing. Cash flows are 20%. That's fine. Long-term cash flow grow by 4%. I'm good with that. So based on that, see the intrinsic value I'm getting for cash flows is $214 billion. Now I'm going to go with a higher discount rate because this is an international company. I'm in the good US of A. And if you're in the US, you get a certain valuation. If you're outside the US, there's a little more risk for me. So I'm going to go to 10%. Now that brings that down the number to 139 billion. Cash was, I think it was up here. So let's go take a look at cash really quick. And it was plus 2818 plus 473. If I read the right line, let's take a look. So short-term investments. I did read the right line. All right. And then debt was down here. Debt was so debt loans payable 2.2. $2,439. All right. So we still get a pretty solid valuation on these guys. If we look at their market cap, it's an $81 billion company, but it's going to go up by 12.8%. So let's go ahead and increase that value. Let's go with plus 81 times, and I'm going to go 112. So tomorrow when we wake up, it's going to be a $91 billion company. So each stock is worth about $2,796, but the stock price tomorrow is going to be priced at $1,809. So I did something wrong there. 1809. So there's a 55% discount if I look at their cash flows. Let's look at their earnings per share. You can see why I was like, hey, this is a pretty good stock. I think I'm going to watch it. And I should have bought it. The one that got away. Oh, no. If I would have bought it a week ago, I'd be sitting on a 12% gain today. But that is investing, folks. You don't buy, you don't participate in gains. Potentially, if you don't buy like Intel, you don't participate in the losses. So the expected earnings per share, $34.51. 50 is fine because there's high growth. Maybe I'll tone it down to 46. Growth rate, really good growth rate next couple years. So I'm going to bring that up to about 10% growth rate. And it presents a discount. I think the earnings per share does not support the stock price. They don't have big margins, so that might be part of it, but they still provide a 27% discount. This is going to be on my watch list, and I am a buyer, especially if this market keeps selling off. This is going to be one of the first stocks that I look to buy. If it can kind of settle down at like $1,700, I am a buyer. We'll see how it goes, and if I buy Mercado Libre, that's a good-looking company. I like to see growing companies, and it's standing up really tall on a day when stocks are selling off in the after hours because two massive companies are down. It's really impressive to see them stand up tall. All right, so we're rounding third, headed for home. We're about to shut this thing down. We're going to end with Shell. Shell is the first big oil company that is announcing their earnings. And I'm just going to go high level. $234 billion company. Now, why are these oil companies worth so much darn money? Well, it's simple. Oil companies of this size, it's not a monopoly. It's oligopolies. There's like 5-6 big oil companies that own most of the reserve rights around the world. And this is the Dutch company that produces oil, and they own a lot of reserves. They extract the oil, get it to market, and they have a very good business. They're mostly in the green, but they do have other competitors. They also have commodity prices. If oil prices are really low, these guys lose money. Right now, they're at like $75 a barrel. That is a profitable zone for an oil company. So these guys should be profitable right now. They should be doing quite well. I expect that when we look at the earnings, it should show good profits, good cash flow. This is also the first one to report. Tomorrow, we're going to see Exxon and Chevron, and I'm a big Chevron stockholder. So when we look at Shell from their financial statements, let's take a look at their earnings. I think it's Shell Investor Relations. All right, so quarterly results. Okay, so here's their results. Okay, they delivered a strong quarter if you take their word for it. All right, so and sometimes they give you a schedule like this, which is fine, but I can't compare it to anything, so I need to be able to compare it to something. I'd rather look at something that shows last year versus this year, and then I'm like, okay, well, it was better or worse. Like here, cash flow for the quarter, 10 billion, and it was at 9.8 billion. Okay, that's good. If you compare Q2 to this same quarter last year, it actually went down a bit by about 2 billion. Net debt went down a little bit. All right. So it looks like their volumes are pretty steady. Okay, fine. And then there's a term in this industry. Upstream means that they extract it. That's like the beginning of the stream. Downstream means when they sell you gasoline. So you're using an end product of the crude oil they extracted. All right. I hate when they kind of make me read through a bunch of stuff and I never get to a financial statement. Come on, people. I just need financials. All right. So maybe this is going to give me what I need. Let's take a look. All right, so Okay, this is small, so let's make it bigger. All right, income statement. All right, so now we're looking at data. Now we're talking. Now we're cooking with gas. So we got 74 billion sequentially. It's better, but it's down compared to, no, it's actually flat compared to last year. That's fine. Okay. Did they make money? They did make money. They made taxable income, $7.4 billion. It's down from the previous quarter, and it is up from a prior year. And these numbers are really tiny. I apologize. Let me make them a little bigger. So they made money. They were $7.4 billion of profit in the quarter, 18.4 for the first half. That's good. Now, these guys, oil companies tend to be really good cash producers. Let's see if that expectation is met for me. So these guys are out of Europe, so they may kind of switch things around for me. Nope, they kept it consistent with the U.S. So they have cash from operations in the quarter at 13.5, in the previous quarter 13.3. CapEx 14.4. So they have roughly about $9 billion of free cash in that quarter. Previous quarter of about the same. Together, they're about $18 billion of free cash in 6 months. Annualize that, $36 billion of free cash. Woo-hoo. That's a lot of cash. I like cash. I don't know if you know that about me, but I like cash. $36 billion of free cash. So when we look at $36 billion, they're a desirable company. Let's say we go times 15 because they're not growing a ton and they're really dependent on commodities. We get to about 440. So it'd be about $500 billion of value, frankly, when you look at that kind of cash flow. So this company is $234 billion. So this is pretty discounted. And I'm showing Chevron discounted at the current time. You can see that these guys are priced below their revenue, annual revenue, which is interesting. They pay a dividend with 3.7, which is good. Analysts say it's discounted. And overall, I think oil companies are a pretty good option for me. I buy into Chevron. I own about $120,000 of Chevron. I'm happy with Chevron. They pay a good dividend, well-operated company. And this is why. They have good cash flow. On a down day when Apple is losing a little value and our friends over at Amazon are losing value, Shell is keeping its stock price. So oil companies, if you don't own one, you might look at one. I like owning oil because it's always a hedge. Usually see when you have an economy that's beginning to slow down for some reason, and I can't tell you all the reasons for it, but oil tends to be surging when economies go into recession. And I can't say that it's surging right now, but if you look at the historic, like you look at 2008, that was a really bad recession. Oil was peaking, and then we got into this horrible recession. It was the Great Recession is what they called it. And for some reason, oil tends to be kind of one of the suspects of an economy getting bad. When oil prices go up, companies have to pay more for energy. Consumers have to be paying more for gas, less discretionary income. Everybody suffers. So that might be a barometer on the economy, oil prices. So Shell looks good. They had a nice earnings. Very nice to see. We'll see what Chevron and Exxon do tomorrow. That's coming up tomorrow. And believe it or not, man, we're not done. We are not done with earnings. We are 4 days through a 5-day schedule. Tomorrow's Exxon and Chevron. Those kind of come out together. You have a bunch of smaller names, but it'll be nice to have a rest. There's also going to be big economic information released tomorrow on employment data. Right now, I think people are a little freaked out that we are going into recession. I think that's a lot of the fear is being driven by fear of recession. You see the collapsing interest rates. That's part of the symptoms of that. If tomorrow we get a bad employment report saying that, hey, there's more unemployment, there's fewer jobs, the market's going to sell off and it's going to keep selling off. And I think it'll be freaked out for maybe a couple weeks. So it'll be a really good buying opportunity. That's a total guess on my part. If the employment report comes in and it shows that, hey, employment's really strong, we don't have a employment problem, that's going to be good. And I think the Federal Reserve kind of put themselves in a position where they did not decide to cut interest rates this month. They're going to wait until September, kind of socialize that, hey, we're probably going to cut in September. But if we have a strong employment report, they'll be like, see, told you, we don't have an employment problem. So we can wait until September to cut interest rates at that time, which would be, it would really make the Federal Reserve look smart. So we'll see what happens. So anyway, guys, it's been an awesome week of live streams for me. I hope you guys have found it valuable. And it's nice to see you, Gabriel Valenzuela from Arizona. Good to see you again, sir. Thanks for tuning in. Hopefully you're having a nice day in Arizona. And then Sion Ken, very nice to see you, dude. Very nice to see you again. Getting hammered with HUM. What is HUM? Got to look at it now. What is it? Just to do a Humana. I steered clear of Humana. Whenever I looked at their financials, they scared me. Why did they scare me? I don't scare that easy. Operating cash flow was negative. Something about Humana just made me walk away. I own Elevance. I own CVS, which is a healthcare payer as well. But take a look at Humana. I think the merger between Humana and Cigna didn't happen. And Cigna rallied because I think investors thought, Humana is kind of a problem child. Hopefully things turn the better direction for you. Hate to see you lose money, but that is a stock that I analyzed, a year or two ago. And I was like, yeah, I'm not going to be all that interested in that company. They're a healthcare payer in the healthcare space. So let's see here. Mike, the dividend guy, you got to run. All right, sir. I looked at Humana, and then Shopify we looked at over the last weekend. Shopify looks interesting, but it looks a little overpriced if I remember correctly. So take a look at the live stream recording if you want to see Shopify. I'm going to need to run soon, guys, because I've been going at this all day, and I need to rest. David, very, very nice to see you, sir. So Sion, yeah, you told me you didn't like it. It was a weekend after I bought it. Sorry about that, man. I guess, I like providing good, interesting information, a point of view. It doesn't mean I offer any financial advice. I never do. But I would love seeing the responses to comments. Sometimes somebody challenges maybe a thought I have or an idea I have. And I take that 100% on its merit. Like sometimes I end up changing my mind based on comments. So I really appreciate comments. Let's go back and forth on stocks and kind of challenge each other. And if you haven't joined the Discord, please join. It's been really good. I just started it like a week or two ago, and we're going back and forth on ideas, stocks, bonds. It's been really good collaboration. Please join. It's on the community page of the channel. Get signed up. It's free. Love to see you on there. Love to see these names because I see some of the names that are on there, but I see a lot of names that are not on the Discord. It's been super cool and really productive. So take a look at it. All right. So looks like your intrinsic value is around 250. It's down right now. Shop. Okay. Let's take a look at Shop really quick. What's going on with Shopify? Did they announce their earnings? So they were down 5%, down 3%. They announced on the 7th. So what's going on? So Shopify is kind of a platform player. They provide software and everything you need to do e-commerce. It was growing fast, especially around COVID. And then it kind of crashed and burned a little bit. Whoa, man, look at this. It's like a tsunami wave. Oh, no. And the stock price came down. Now, are they worth $75 billion? Maybe. Every time I value them, I kind of get around their value. And I'm like, well, I don't want to buy something that's going to be worth the same amount of money in a couple of years, or maybe even worse if it goes down. I've been bitten by, I bought Zoom and it never went anywhere. I've been kind of just patiently waiting for it to do something, but analysts say that it's discounted by 31%. So maybe I'm going to do a deep analysis on Shop, and I might do a video on it. And then Toyota Motor, I'll take a quick flyby on that. I stay away from car companies, and the reason for it is the market just doesn't like them. I own Ford. They generate more cash than, let's say, a technology company or another sector company. The tech company is worth 200 billion and the car company is worth 50. And it's like, how's that possible? And they keep getting sold off. Ford sold off big this year after it had a nice rally. And I'm like, man, just the market does not like car companies. So Toyota Motor is arguably, and you would get my vote, that this is the best run company in the car business on the planet. Great quality, right models in the right markets, global business. You got my vote. $300 billion business. You're paying less than the annual sales for the company. So this company, I would venture to guess, is probably going to be priced fairly because they have had a very good stock rally. Maybe now they're down. Man, they're down quite a bit. Now, I don't want to buy another car company. I've been bitten by, the stock market saying, hey, dummy, don't buy car companies. Buy companies in the green. Buy companies here. Car companies, that industry started over 100 years ago. There's 50 competitors, and there's new competitors coming out of China that are going to make EVs that are really affordable. So I'm going to stay out of the red, and car companies are not exactly in the red. They might be dipping a toe in the red. But why buy car companies that are kind of old businesses, in a lot of ways, very old businesses? I'd rather go find the next Uber, find the next Google, find the next Meta, find the next Amazon. Maybe Mercado Libre is the next Amazon down in Latin America. I want to operate in the green because that's where the money's at for me. And that's where I made a lot of money. And car companies are not going to be part of my recipe for success going forward. All right. So, yeah, join the Discord. And then on Saturday, the invite isn't out yet. If you want to be part of the call that we call in, we talk about stocks, we go over stocks. On Saturday, it's probably going to be around the 10 a.m. Pacific time frame. And I'll send that information out on the community page. Keep your antennas up if you want to tune in. If you want to be part of that, you have to send me an email. And then I put your email on the invite list. And then you could show up and join a Google Meets call, which will be turned into my podcast. It's been really good sessions. We've had really good content on there. We could speak through items. And a lot of the speaking happens with community members, which bring ideas and points of view, which is awesome. So, guys, I would like to so one more comment. So do you have a Discord invite link? Do I have it to never expire? I'm new to Discord, so I got to check that. Thanks for that comment. I'll double check it and make sure that it's not expiring on you guys. But thanks for the comment. So, guys, thanks for tuning in. That was day 3 of massive earnings. What a week, man. This week really teaches everybody a lot. No matter how many years you've been investing, it really sets the table for the next couple months of investing. I think there's money to be made. If we just got to do the homework, we got to find the companies that are discounted, buy them at the right time, then watch them rise. And tomorrow will kind of be an easy day because we just have those big oil companies and a couple other companies to go. But then next week, we lace them up again and we go over some really neat, more mid-sized companies that are going to announce. And that'll be fun too. But this week's been awesome. I really appreciate everybody that's tuned in for the last 3 days. I hope you found it interesting. And I hope everybody has a great night. Take care and good luck.